Well, hello everyone, and welcome. Thank you for joining our Lear February 2025 Market and Strategy Update. My name is Tom Steinley. I'm Director of Business Development at Lear. I'm joined by our host, Co-Portfolio Manager and Head of Research, Jim Warner. If you haven't already, I would encourage you to read Jim's most recent market newsletter. In it, Jim very succinctly frames some of the issues facing the new administration, including tariffs, the expiration of Trump's 2017 tax cuts, and inflationary concerns, as well as the advent of DeepSeek's R1 AI model. More importantly, how do these external pressures impact our portfolio positioning, which I'm sure Jim will cover in his presentation today. For us, these monthly webinars are more than just a data dump. They're an opportunity for us to highlight market and economic information as it relates to what we own in the portfolio, and as importantly, why we own it. Before I turn it over to Jim, I have a couple of reminders. We encourage you to ask questions. To do that, please use the Q&A box at the bottom of your screen. And also, I want to let everybody know that as a follow-up, we will be sending the compliance-approved replay of today's presentation, as well as the accompanying slide deck that Jim has prepared. So with that, Jim, let's jump right in.
Great. Thanks, Tom. Thanks, everybody, for being here. Let me just share my screen with our presentation. So it's great to have you all here. And I think, it's really important to step back every so often and look at what's, look at the forest from the trees, and so the presentation's title this month is called Cutting Through the Noise. And there's been a lot of noise over the last few months, right? We had a very important presidential election in November. The market ripped on that news. Then we had a sell-off in December as the market tried to assess the impact tariffs could have on inflation, and interest rates rose on the back of that. And then we had a nice big rip in January with some noise thrown in there with DeepSeek and then obviously the tariff news. So we're going to go through all that. Just as Tom mentioned, I would absolutely recommend that you get your hands on our newsletter, which usually comes out kind of in between these webinars. And the reason is that I tend to play off of the last webinar in the newsletter, and I'll play off of the last newsletter in this webinar. So oftentimes, to sort of keep up the pace with our thinking, it's really great to kind of think of these two pieces of information as kind of central to understanding how we're thinking. And then we also put out other research, so I encourage you to try to get your hands on that too. You can always talk to Tom, Keith, or myself to be put on any of those distribution lists. So without further ado, let's cut through the noise. So we had sort of this DeepSeek table flip, and what do I mean by that? Let's first talk about DeepSeek. I'm not going to rehash this entirely. You can read it. We did actually a separate report on DeepSeek and went into some more details. But the key here is that DeepSeek claims to have trained a large language AI model way cheaper than what Meta, Google, Microsoft, OpenAI, their partnership is doing. And so the key concern that came out of that, there was, of course, a knee-jerk reaction that all is over for AI, and that can be further from the truth. As far as we think, we're not even in the bottom of the first inning in terms of AI and that trend. But what it did do is it raised a concern about demand for the very high-end NVIDIA GPUs, and would that be lower in the future? And so NVIDIA has really been the one that's taken this mostly on the chin, and therefore, the concern is that there will be less need for those GPUs in the future. The allegation, by the way, that DeepSeek is making is that they use something like 20,000 A100 NVIDIA chips. And, a number of experts have come out and said there's no possible way that they did that. And it must have, but that's how people are arriving at this $6 million claim as you take the GPU cost and multiply by 20,000. So at the end of the day, there is some question marks as to just how much it cost. But the point here is that it was cheaper, and there was some innovation in how their large language model was developed. I won't go into the technical stuff about it, but the reality is that what this is an efficiency improvement that could mean it's a lower cost or burden to develop AI applications on top of these large language models. And so this is really good for software companies or any company implementing AI in their business, which is many. So that efficiency is going to get incorporated, and it's normal, right? It's normal for technology as it advances to become more efficient, right? Everything gets smaller, everything gets faster. It'll require less cooling. Things of this nature is a natural progression in any evolution of any technology. But what is interesting is that last week on their earnings call, Meta and Microsoft indicated that there is no slowdown in CapEx spending. And last night, even Google came out and they dramatically increased their CapEx spending. And it's all primarily going to these AI data centers and the NVIDIA chips themselves. So it turns out that a lot of this has been essentially a big buying opportunity, even probably for NVIDIA. We've certainly been nibbling around at the edges on some of the AI stocks that we really like. We're going to kind of continue to monitor this, but I think ultimately we think that this is going to be good for the overall evolution of AI. So let me move on past that. Now, what we've had this year is really interesting. What DeepSeek did was it kind of put a pause on the Magnificent Seven's performance. As we all know, the Magnificent Seven has been driving performance both last year and the year before. Last year, the Magnificent Seven drove 75% of the index's return, and a lot of that was NVIDIA, as we pointed out in our last webinar. If we look year to date, now granted, we're only a few weeks into the year, but this is sort of interesting. The Mag 7, if you look at this graph to the right of this red bar, are basically flat on the year. And the S&P is up about 2.8%, about 2.5 or so as of yesterday. And all of it is the other 493 index members. We've talked a lot in the past about wouldn't it be great if we could move past the Magnificent Seven and get some participation from the rest of the market? And it could be that this is the year that we get that flip-flop. It took something eventful like DeepSeek perhaps to initiate that kind of mean reversion that we would hope for. But at any rate, it's something worth watching and certainly worth noting at this point. Now, if we look specifically, specifically at NVIDIA, the stock is up about over 70% over the last 12 months, but it's down 20% from its highs. It's having a nice little bounce back today. I think that's partly due to Google's comments on the CapEx. But if you look at it, it really hasn't done much for the last 6 months out of that 12. And if you also look, you can see this big dip that it took on the announcement of the DeepSeek here. And that took valuation down to about 27 times forward PE, which if you look at the chart on the right, it's towards the low end of where it's been trading over the last 12 months, but things have changed a little bit. It's really important when you think about pullbacks, and I've written about this a lot, is that there's a difference between a technical pullback where basically buyers are exhausted, or there's some other reason driving a sell-off in a stock, and a fundamental pullback. And a fundamental pullback is when the fundamentals really do change in a stock, and that the future earnings aren't what you thought they were going to be. And DeepSeek does raise a bit of a question about that, and that's why you see this compression in PEs. At 27 times, though, it's still not crazy cheap. But we just want to point out what's going on there, because a lot of people have NVIDIA. In fact, a lot of people have too much NVIDIA in their portfolios, and we spent a lot of time talking to clients about that. There's still no, I would say, green light to back up the truck on NVIDIA, but it is certainly a case that we're going to need to learn more about the efficiencies and what it's going to do for long-term demand on their GPUs. But so far, so good. It looks like all the big hyperscalers are continuing to purchase in massive quantities. Okay, so that's DeepSeek. We're happy to talk about that more or answer some questions on it later. Let's talk about tariffs. So the tariff was a surprise. No, not really. We've known that tariffs are coming for for months now. Pardon me, allergies. And a lot has changed obviously in the last 72 hours in terms of what were the tariffs going to be. Now they've been sort of put on hold. But let's just talk about it and frame it anyway. So we have basically last year the U.S. imported nearly $3 trillion dollars worth of goods. And that's actually through the month of November, so it leaves off December. But 3 trillion is a lot, right? And about 58% of it comes from the rest of the world. Mexico, Canada, and China account for 42%. So, where Trump is going with his tariffs is really tackling the top three trading partners. Germany's in fourth with a distant 5% of imports. So it's a big deal that he's going after these three companies. And as you can see, actually, our biggest trade partner is with Mexico. If you look at, essentially what is getting imported, it really breaks down into being about a quarter of it is automotive related. So very often what you'll see is parts of cars, made in, say, Monterrey, Mexico, then they're shipped over the border and final assemblies in Fort Worth. There's a lot of that's going on. There's a lot of energy that's imported, whether it's oil, natural gas, or actual energy products. That's about 20% of our imports. Most all of that is coming from Canada, so that's a big trade partner on energy. And then we've got electronics, which of course is China, and a little bit of Mexico. And then there's a bunch of other stuff that would include agricultural goods and things of that nature. So as you start to look at sort of what industries are going to be most affected, you can really, this slide pretty much spells it all out, but it's really automotive for Mexico, some agriculture as well, and with Canada, it's principally energy, a little bit of automotive and whatnot. And China, electronics is really kind of the big dominating factor there. So this is an evolving story. The proposed tariffs are 25% on Canada and Mexico, 10% on China. The Canadian energy products would only be tariffed at 10%. Now, this has all been put on hold. You've probably heard that, the Mexican president came out and said that she'd send 10,000 troops to the border to, supposedly stop, the trafficking of fentanyl and humans across the southern border. And the Canadians have basically promised to install a fentanyl czar who also would, be monitoring and cracking down on trafficking of fentanyl into this country. Obviously, securing the border is a big campaign promise from Trump, and so he's sort of making do with this proposal. Now, these are on pause, so we have to wait and see. Will Mexico and Canada follow through? Will we actually get tariffs? It's anybody's guess at this point. But the size of what is being proposed is massive, and I think this is why Canada and Mexico sat up straight. This is estimated, if it was implemented, the tariffs would hit Canada's GDP by 5% and Mexico by 8%. I mean, that's worse than a bad recession. That's like a depression. So clearly, this is something that they don't want. And what you're seeing is that Trump is carrying a very, very big stick and is willing to use it to get what he wants, presumably on the border. We're not sure if ultimately these could be permanent. We don't know exactly what the point is, like whether it's strictly fentanyl. I recognize that fentanyl is the stated reason, but because from a legal perspective, that's how Trump can actually implement the tariffs. But I'm sure immigration, trade fairness, bringing jobs back to the United States, all these things are sort of encapsulated in this strategy. What is the impact to the U.S.? Well, I think the way we have to think about it is the substitution effect. Avocados are going to be more expensive. Do I have to eat an avocado? It's that sort of thing. And I think unless there are specific cases, like for example, people in Vermont get propane from Canada, that would go up in price by 10%. And you can't really substitute that. So, if you've got basically, the impact is going to be essentially whether or not you can substitute for that higher price or not. For businesses, this actually could be potentially very terrible, particularly for automakers. Anybody who's making things in Canada as part of this, anybody who has a supply chain that is in Canada or in Mexico and then bringing it across the border, their products just got a heck of a lot more expensive. and in some cases could eradicate all of their profits. So, it's a big deal for those. And, our view is just avoid, the sectors that we think are going to get hit. Um, I was listening to, as you all know, we're in Dallas, and we just had a very big trade in the NBA with Luka Doncic leaving. And there was an interesting interview that ESPN had with Robert Kraft, who's the owner of the Patriots, and they asked him his opinion. He basically just said, I'm not gonna give you my opinion on the trade, but you need to look beyond the headlines. In other words, he's referring to, well, there must have been something going on behind the scenes or with his agent or his family or whatnot, or we don't know the reason, frankly, for why Luka was traded. But the reality is that it's beyond the headlines. And I think it's really, really important if you're going to successfully invest in this market, particularly with the noise that comes out of, whether it's tariff noise or whether it's DeepSeek noise or any of these other things, you have to look beyond the headlines, and you can't just knee-jerk react like the rest of the market does. So that's our basic approach is to be patient, and we'll talk a bit more about that again. If we look a little bit further, at the impact on inflation, there are a lot of talking heads out there talking that are saying that, oh, if these tariffs go in, we're absolutely going to have inflation. The reality is far from that. It is very difficult and hard to say what the impact would be on inflation. I think some economists have basically suggested that maybe it's a 50 basis point increase in the overall headline inflation numbers. But when you look at the Trump 1.0 tariffs, as some economists have done, there really was a very limited impact on when those tariffs were implemented. And so, and then if you really stop and think about what's happened in the last few years, you've had a surge in inflation. So good luck trying to pass on price increases after that record inflation, right? I mean, ask Whirlpool, who manufactures 30% of their washers and dryers in Mexico and Canada, ask them to try to pass through, a 25% increase to the consumer. They can't, because demand for their product is down a lot and prices are actually going down, not up. So anybody who claims to know how this would work out from an inflation standpoint is just frankly overconfident and probably out over their ski tips. That being said, what does real-time inflation look like? As most of you know, we like to look at this real-time measure of inflation from a company called Trueflation. You can find this on the web. And right now, it basically is suggesting that inflation is right around 2.2%, which, of course, is getting really close to the Fed's target. And, if you put this within the context of tariffs, and the economists are right that, there's a 50 basis point increase to overall inflation. That's not super damaging, right? We were kind of just there. So, who's to say what actually is happening? But, you have to still invest. And so how do you position your portfolio for these types of uncertainties? And the first thing that we do is avoid the trouble before it happens, if at all possible, right? So tariffs were very well telegraphed. We could see that coming a mile away. And so we avoided investing in companies that would get caught up in that tariff stuff. DeepSeek, that was sort of a surprise, although DeepSeek, frankly, announced to the world its discovery back on Christmas Day. And so if you were paying attention, you saw that something was coming out of China. We didn't know exactly what, but it was, and it's certainly not a surprise that there's innovation going on within the world of large language models, which are frankly quickly becoming a commodity. But nevertheless, that was sort of a surprise, and you just have to dig into the details as they arrive. The market hates uncertainty. So in any time one of these externalities pops up, you're going to get a knee-jerk reaction. It is really important not to freak out when you see a down day like we had this Monday and then last Monday. Think about it this way. If we're actually in our investment committee meeting on Monday morning, and the market's sort of melting down over the tariff stuff, which again was no surprise to us, and our stuff was fine. But you could have said, "Oh my gosh, we need to sell. We don't know what's going to happen." And the reality is, if not hours later, you had the Mexican president and Justin Trudeau up in Canada basically get delays pushed out by acquiescing to some of Trump's terms. So how dumb would that have felt, right? To have sold Monday morning and then you get this bounce back. So the point is you've got to expect the knee-jerk reaction. And then you've got to ask yourself, is this a technical or fundamental issue? I talk about this all the time. Now, what in this particular case, DeepSeek and tariffs are frankly potentially fundamental challenges to businesses that they impact. And that's really important because that means when we run out our projections for what we think these businesses can earn, it could go a lot lower, and that's bad for the stock. So the point is that you then have to assess it. Is it technical? Is it fundamental? And what is going to be the impact? And frankly, we're still figuring out what the actual impact is going to be for DeepSeek. But you can address that on a variety of different ways by, like I said, you can avoid the situation altogether, or you can actually start to process the information, such as listening to the earnings calls like we did last week on Meta, Microsoft, and last night on Google, where it becomes very patently clear that their spending plans haven't changed for NVIDIA GPUs. So the point is that you got to really understand the situation and then buy the unfairly punished stocks. That's really important. There's a lot of stocks that got dragged down in this DeepSeek thing that are where DeepSeek and the implications of developing more efficient AI models is fundamentally a good proposition for them. Like, for example, Oracle got hammered on that day, and this is actually net positive for Oracle and the products that they sell. So buy those things, right? Understand the issue, and then buy the things that were just guilty by association. And then take the opposite side of extreme consensus opinions. The analogy I always give people is that when everybody's sitting on one side of the boat, you better start thinking about moving to the other side, because it doesn't take much when everybody is long a trade to quickly move to the other side. And you've seen that, right, in NVIDIA. It was the most popular trade last year, and it still was going into this year. And it wouldn't take much to upset the apple cart. And so you've got to be aware of where you're in when you're in crowded names. And now for us, obviously, we've been underweight. For the last few been underweight NVIDIA and long other AI names. So it really has no impact on us. But part of the reason for that is because we just saw an extremely crowded trade, and it wouldn't take much to see it blow off 20%. And that's in fact what's happened. And the last thing I would just point out is that investing in a Trump world or era is nothing new to us, right? We've already done this for 4 years. So, so we don't take every tweet that comes out or every headline at face value. You just can't. I mean, I think we all learned that, during his first presidency. And I think that, we didn't have to necessarily do that under the Biden administration, but we do now, right? We now have to basically ask the question of, well, what does he really want? Why a 25% tariff? What does Trump really want? And I think we have to take that attitude with literally anything that comes out of the White House. Now let's take a step back from AI, take a step back from tariffs, and quickly just look at where are we in the economic cycle. This is just simply a graph of U.S. real GDP. And what you can see is that we've been sort of chugging along nicely ever since the kind of growth dip back in the first half of 2022. Q4 GDP looked like it came in at 2.3%. Most economists are predicting somewhere in the 2 to 3 range for the rest of this year. They've also talked about possibly a 1% GDP hit if all these tariffs are put in place. That's slower growth, but that's not a recession. So in our worldview, at least as we see it, we still live in a very strong economy. The labor market's still strong. The consumer spending is still strong. And so, we should have decent setup for risk assets. The other thing that we don't talk about a lot, but I think is interesting to point out, is that, a lot of what's driving the economy is the fact that disposable income has remained solid. So, this is sort of the chart on the left is kind of a long-term view of the actual dollars of spending, which is around, $18 billion. Actually trillion. But you can see the spikes. These are the stimulus payments on the left. And then we sort of had this dip in 2022. And then that dip, right? So this is real disposable income that we're charting. So that means that this is, the nominal less inflation. So that dip in spending power is when inflation spiked. And as you can see, though, as inflation's come down and nominal wages have continued to grow steadily, we've seen a nice recovery in real disposable personal income, and that's what's really driving this economy. The chart on the right is merely just the year-over-year change, but you can see that we've got not rip-roaring disposable income growth, but it's still growing. And that is that is the fuel for this economy. So any changes to this, of course, would make us rethink, the economy and its footings. All right, so let's talk about portfolio strategy. So beyond the noise, we raised some cash in December. So just to back up, right? November was a terrific month. So we took some profits in December. And that was great because then we started to have we had a sell-off in December, and we were able to redeploy that cash in January. When we talk about being tactical, this is what we mean. But basically, our trading activity has been fairly muted. We've, I think, done a good job of being patient and looking through the noise, focused on the fundamentals. We've had an earnings season. We're several weeks now into earnings season. A lot of it is coming through better than expected. So, businesses are feeling, pretty optimistic about what 2025 looks like. And that's helping these stocks recover and look through some of these issues like tariffs and DeepSeek and whatnot. As I mentioned, our holdings are fairly insulated from tariffs, and some could even benefit. Next on the block is going to be the EU, right? So that they're the next ones that are going to get pegged with, 25% tariffs or whatever. Now, and, could there be retaliatory tariffs? Yes. But one thing that they absolutely need to have, and one thing that, frankly, Trump may demand, is that they buy more LNG. They need LNG. That's something that they can't do without. They're one of the biggest consumers, particularly as Russian natural gas is no longer available to them. And so that would obviously benefit our Cheniere energy trade. Trump could also demand that they increase military spending. We know he's done this in the past. That would be great for Lockheed Martin and our Kratos trade, which is in our tilt model. But we're basically being very patient. And wherever we see, crazy sell-offs that really are not where fundamentals really haven't eroded, we will look to add to those names, like I mentioned earlier. One thing we don't do, and partly because historically we're not very good at it, is trying to guess who wins and loses on tariffs. In other words, particularly who wins. So if you say, we raised tariffs on China, is there a U.S. stock that really benefits from the Chinese products being more expensive? That's a really tough game to play. What we would much rather do is buy and look for things that get oversold on concerns that maybe the tariffs are too punitive. But that's a much easier game to play. But like I said, we're staying patient. And we're still leaning risk on. This economy is fundamentally strong. Once you strip away the noise, there's plenty of strong areas of this economy to play in. And to that end, we're looking to add exposure in areas like financials and healthcare and other non-AI names. We're still, buying AI, but the reality is there's other parts of the economy that we think are strong and growing faster than expected by the market. Then the next thing up in terms of noise that we're going to hear about is the tax cuts. So I wrote about this in my newsletter. There is no more important thing that Congress can possibly do for the stock market than to extend these tax cuts. I don't know if anybody read my last newsletter, but I go into some of the comments that the new Secretary of Treasury, Scott Bessent, made, that basically it would be, a multiple $1 trillion increase in taxes to American taxpayers. And that would just really stifle the economy. So that is something that is, next on our list of really big things that we need to look out for. I think most likely we'll see a reconciliation bill this summer. That seems to be the most likely time frame. And it's going to be a mess. It's going to be very complicated to get through. The Republicans, as you know, hold a very slim majority. It should get done. but we don't know, we really have no edge at this point on the shape and contents of it. I'm going to speak very briefly about our family of models. As you know, the Global Vigilance family is our sort of flagship strategies. It comes in a conservative, moderate, and tilt, which is our aggressive version. I mentioned to Tom coming into this call that we are actually beating the S&P in all three of these strategies right now, year to date. That's something that I've probably never said before, because we're certainly not necessarily trying to beat the S&P, particularly in a conservative strategy with, as you can see here, 30% equities. But we've had some really decent stock picks, and this is really, kind of the environment that we look for, where it's a stock picker's, nirvana at this point. So we're really happy where we are. And some of the themes, none of the themes have really changed since we last spoke, but we're certainly happy to go through them, with you now or offline at your convenience. So why don't we just stop there, Tom, and let's see if anybody has any questions.
Great. Thank you, Jim. As always, that was very informative. Let's hang out for 20 or 30 seconds until we can determine whether anybody has questions. Typically, we like to keep these webinars to 30 minutes. So if there are no questions, I think we can wrap up. But certainly, Jim and I, or anybody else at Lear, is available as a follow-up if any information is needed or any questions arise. But at this point, Jim, it looks like there are no questions. So I just want to thank everybody, excuse me, for being with us today. And specifically for my friends in the Philadelphia area, I wish the Eagles good luck this weekend in the Super Bowl. And thanks again for your partnership, and we'll talk to you in March. Thanks, Jim.
Thanks, everyone.